Hello, welcome back, and let's talk about the Wyckoff trend analysis and how the Wyckoff trend analysis can help you understand charts in a much better way. So let's get down, and first let's start with the basic concepts of Wyckoff trend analysis. The Wyckoff trend analysis uses a few different terms and concepts that we can see in this pattern, or in this screenshots, and obviously this is just a markup, and soon we will get into the real charts. So here is a downtrend, and once a downtrend is over, you will often see that an accumulation is starting when the market moves in a sideways range. The downtrend, we cannot really say that it's completely over because we don't have all the context, but during the accumulation or during early accumulation phases, we can often see that the previous downtrend is slowing down. It's not able to push lower anymore. Often we will see that you often see patterns like a double top, a double bottom, maybe even a divergence. It's already indicating that the previous downtrend is slowing down. And what often happens is that you have a final attempt, a final continuation attempt, in this case a final attempt to continue the downtrend. In the Wyckoff analysis it's called a spring pattern because very often it springs back into the accumulation phase, so it looks like a failed breakout or a failed continuation. So you can see we have a downtrend, then the downtrend slows down. You have a breakout that immediately gets rejected and falls back into the whatever pattern this is, accumulation, a double top or bottom. And then it is often the case that once the spring pattern has formed and once you have seen that the continuation has failed, a breakout to the upside then follows. And once the market breaks out of the accumulation phase, then a new trend will start. It's called a markup or an uptrend, whatever you want to call it. And then the same thing repeats itself. You can see the market would have rallied higher. Obviously, this is just a drawing, but you will see it in the live charts that it's the same. The uptrend continues, or the uptrend goes on, and then it enters a distribution phase where the market is not, or the price is not able to push higher anymore. The uptrend here slows down. It enters a double top or another pattern, a triangle. Then you have a spring pattern, a failed breakout attempt that immediately gets rejected. The price falls back into the consolidation phase. And once this is clear that the uptrend was not continued, that the buyers were not strong enough to continue the uptrend, the sellers stepped in and drove the price down back into the distribution, then the trader would just wait for a breakout to the downside and then trade the new downtrend. So you can use the Wyckoff trend analysis in a few different ways. Obviously, you could trade the breakouts here and then use your knowledge about when the market is slowing down to get out of trades. You could even trade the spring pattern when you see that the spring pattern fails, or when the spring pattern builds and the breakout fails. You could try to look for an early signal, or if you are in a trend or in a trade and you see that the market is entering a distribution pattern, or maybe see that a spring pattern is building, then get out of a trade. So let's look at a few chart examples, and you will be able to see this across all the markets, across all time frames, all the time. So it's really a pattern that you will start seeing very often. So here you can see the market was in a downtrend, very strong downtrend. Then here suddenly you can see, looking at the downtrend, suddenly a very strong bullish phase, much stronger pullback than what you have seen here during the downtrend. So this is your first heads up. Then the market makes another run at the previous lows, makes a spring pattern, it tries to break out, but immediately gets rejected. The price is not able to push lower, it falls back into the accumulation phase. And after, you can see after the spring pattern has formed and after the price has been rejected, now you can see a series of very strong bullish candles. Whereas if we look previously at all of this price action, we never even saw something like this. We never saw a bullish sequence as strong as this. So you can see already The trend is slowing down. We have a long consolidation. We have a spring pattern. We have a strong run here after the spring pattern has formed. The market rallies into the previous highs. It doesn't immediately break it. This is what I call a lower bounce pattern. This is a pattern that I trade in my real trading account, and this is also something you can learn in the description below about. We have a very special deal where you can get my premium course and even my mentoring for free with the terms and of the deal. So make sure to check the link in the description below. So once this forms, I call it a lower bounce. The market is not able to pull away from the pattern and from the previous resistance area. Afterwards, you have then a strong breakout. So this could have been your initial entry, of course. Then the market rallies, it comes back and makes a retest. Many traders use break-even stops in their trading, but I have found that break-even stops are a sure way to lose your money. Why? Well, if you enter here on a breakout, then the price rallies a little bit. Where are you going to put your stop loss? You trail it obviously here to your entry point because you want to have a risk-free trade. It doesn't exist. There's nothing risk-free in trading. I keep repeating this over and over again. And then once the market has retested the previous structure, then the rally continues. And this is just something that happens so often. A trend, the trend slows down, failed breakout, a strong rally, the lower bounce, a breakout, here a little bit of a run-up, a retest, and then off we go. So this is a pattern that you will see time and time again. This is a trade which I am still in. The market is almost at my target. There's just like one or two, well, not one or two, but like 4 or 5 pips left at the moment of when I'm recording this. So you can see, let's start here on the left hand side. The market was in a downtrend. Then here the downtrend slowed down. We have a very strong breakout attempt with a very, very strong wick. The wick gets immediately rejected here. And after the wick, I'm not sure if you can see it. Let me try to zoom in. After the wick, you can see the wick forms. And then here the long bullish candle. It is very, very long. And again, after a wick or after the spring, you will often be able to see a very dramatic shift in market behavior. So you can see here previously the market was moving more or less orderly, but nothing like this here. Nothing like this strong candle. And if you see such an outlier candle, if you see something that you haven't seen in maybe, how many candles are this? Maybe 40, 50 or 60 candles. This should really pique your attention. Again, here also the spring pattern, a very, very long rejection. We haven't seen it anywhere in this previous market structure. So we have a very long wick that immediately gets rejected here with the spring pattern. And here the breakout candle is such a long bullish bar that it should really get your attention. The market breaks out here above the previous high, makes a little bit of a run, comes back, makes a perfect retest here, and then here the markup continues and the uptrend starts after we have put everything together. And then the market enters another sideways consolidation after the uptrend. Here now the market is in a distribution phase. We have a spring pattern here, a failed breakout above the previous highs. And after the breakout or after the failed breakout, you can see a huge bearish candle. Let me zoom back in. Let me get back here. So here you can see a huge bearish candle. We haven't seen anything like this huge candle in all of price action here, probably more than 100 candles or roughly. And yeah, this should really get your attention. A failed breakout, the buyers are not strong enough, and then suddenly the sellers really step into the market, drive the price down, a breakout happens, the market comes back, makes a retest at the previous lows, and then off we go. And this is just something you will not see all the time. Of course, nothing works all the time, but you will see this very, very often. Here another one, a markdown. The market was in a downtrending phase. Then here we have a double bottom, a failed breakout, a good wick that indicates here the spring. Then the market rallies back into the previous highs, makes a low, but previously you can see the price always made lower lows, lower lows, lower lows. Here it fails the first time to make a lower low, and now here after the spring pattern it makes a higher low. Very, very important. Higher low, double top, double bottom, and a very good indication that the strength is shifting here. Then the market makes a breakout, it comes back, not a 100% precise retest, but you can see if you move your stop loss to break even, you will be taken out eventually, and then the markup continues. So this is really something that you can use in your trading. Another opportunity would be, for example, that you look for those retests on the lower time frame, for example. So after the breakout has happened, you go to a lower time frame, you wait for the pullback and then trade it there. There are many ways how you could use that knowledge. Another way would be you could use a Bollinger Band. Bollinger Bands measure standard deviation, and you can see during normal market behavior the market will almost never be able to trade outside of the Bollinger Bands. But if you see such a huge move outside of the Bollinger Bands, and not just a small penetration like here, then it really should get your attention. And especially if it's in the context of a spring pattern, a failed breakout, and then here you have the real breakout from previously, the retest, everything really comes here together. Of course, you could also use an RSI divergence. So the market was in an uptrend, and then here at the top the market slowed down. A divergence will confirm that. A divergence is a momentum indication or a momentum analysis tool. So if you see a divergence, it means that the price here did make a higher high, but we can see that the RSI didn't make a higher high, which means that the market is losing strength, and we can see it from price action. Here, a very strong uptrend, very vertical move, and then here it slowed down. Here the price barely made another high, and then immediately fails. And more interesting, after this failed breakout here with a spring pattern, now suddenly you have large bearish candles, which you didn't have previously. And then you can see a markdown, the retest here again. Where does this retest? At the previous low point. So here was the breakout point. Then the retest happens right at the breakout point, and it continues again. So you have many ways how you can use that. And I really encourage you to start paying attention to this market behavior, a trend that slows down, a failed breakout that it reverses, candle structure, and then breakout and pullbacks. This is really going to help you analyze charts, and all charts, whether it's Forex, commodities, index futures, or regular futures, or whatever you're trading. It will help you analyze markets in a better way, a more effective way, and also look a little bit behind just pure price action, but really understand what is going on in the markets.